Hi, everyone, and welcome to week 7 of our I Spy Academy course, where we dive deep into one of the most important and misunderstood parts of investing, valuation. Up until now, we've explored what drives markets, sectors, macroeconomics, and the instruments we trade. But this week is different. This week, we're not just asking, what is the market doing? We're asking something far more powerful. What is a business actually worth? Valuation is the foundation of long-term investing. It helps us separate price from value, hype from reality, and emotion from analysis. But here's the catch. Valuation isn't a crystal ball. It doesn't tell us what will happen. Instead, it gives us a structured lens to understand what might happen and whether the current price makes sense based on fundamentals. So, whether you're a trader looking to avoid overpaying or a long term investor trying to find undervalued opportunities, mastering valuation will sharpen your strategy and deepen your conviction. Let's get started. By the end of this week's session, you'll have a solid grasp on the core tools of valuation and, more importantly, how to use them to make smarter decisions as an investor or trader. Here's what we're aiming to accomplish. First, you'll understand the critical distinction between price and value. The market tells you what something costs, but valuation helps you figure out what it's truly worth. Next, we'll break down and apply some of the most important valuation metrics in the financial world, including PE, PB, PEG, and net EBITDA. These will become essential tools in your screening process. You'll also get an introduction to intrinsic value models like discounted cash flow and learn how to think in terms of long-term value, even when the market is distracted by short-term noise. We'll compare growth versus value investing mindsets, look at real companies through a valuation lens, and most importantly, learn how to spot red flags that could make a stock look attractive on paper but dangerous in practice. And finally, you'll leave this session with a more grounded mindset, one that blends logic with humility. Because valuation isn't just math, it's a judgment call. And your edge will come from knowing when to trust the numbers and when to question them. So let's take a step back and ask the big question, what is valuation? And why does it matter? Valuation is the process of estimating the true worth of a business based on its financials, assets, future cash flows, or how it compares to other companies in the market. At its core, valuation helps us answer one critical question. Is this stock actually worth the price I'm paying for it? Because here's the reality. In the stock market, price does not always equal value. A stock trading at $200 could be undervalued if its growth potential and cash flow justify it, or it could be wildly overpriced, inflated by hype or crowd behavior. Price reflects the market's opinion. Valuation reflects your analysis. So why does this matter? Let's break it down. First, markets are often irrational. News, fear, and herd mentality constantly distort prices. Valuation helps you filter through that noise. Second, a solid valuation thesis builds conviction. If you understand why you're invested in a company, you're less likely to panic sell during short-term volatility. Third, valuation gives you a foundation for screening. It helps you quickly compare dozens of companies and spot red flags or hidden gems. And finally, it helps you link your strategy to your risk. When you understand what something is worth, you can make smarter decisions about when to enter, when to hold, and when to walk away. Now, here's what happens without a valuation framework. You end up chasing hype, buying high and selling low. You confuse popular with profitable. You overpay for flashy companies with weak fundamentals. And you overlook high quality businesses simply because they're not trending. The key takeaway, Valuation is not about predicting price movements. It's about identifying opportunities where the market has mispriced a business and positioning accordingly. So let me leave you with this question before we dive deeper. What do you think matters more, the price you pay or the quality of the company you're buying? Now that we understand why valuation matters, let's look at how it's done. There are three primary approaches to valuation: relative, absolute, and asset-based. Each one offers a different lens on what a company is worth. And depending on the situation, one method might be more useful than the others. There's no single right method. Each has strengths, weaknesses, and ideal use cases. Let's break it down. Relative valuation compares a company to its peers using ratios like PE, PB, EV, EBITDA, and PEG. Absolute valuation aims to determine a company's intrinsic worth, most commonly using discounted cash flow models. Asset-based valuation focuses on what a company owns, its net assets or book value. Let's look at each one in more depth. First, relative valuation. This is the most commonly used approach in public markets. Think of it like this. What is this company worth compared to similar companies? It's fast, accessible, and widely supported by financial platforms. Tools like the P/E ratio or EV/EBITDA help investors benchmark companies against peers in the same industry. But here's the catch. Relative valuation assumes that the peer group is fairly valued. That's a big assumption. The risk? It doesn't account for company-specific risks, strengths, or unique opportunities. It's great for screening, but not always enough for conviction. Imagine you're shopping for a used car. Two identical Honda Civics. One is listed at $15,000 and the other at $22,000. You assume something's off, right? That's relative valuation, spotting mispricings based on comparables. Now, let's take a look at absolute valuation. This approach asks a deeper question. What is this business worth on its own, regardless of what others are paying? The most common method here is the discounted cash flow DCF model. It estimates the value of a company by projecting future free cash flows and discounting them back to present value. This is the most rigorous method, and it's commonly used in private equity, long-term investing, and M&A. But it's also sensitive to assumptions. Small errors in growth rates or discount rates can produce wildly different outcomes. Think of it like creating a personal financial plan. You forecast what you'll earn, what you'll spend, and what your future cash flow is worth today. Lastly, we have asset-based valuation. This method shifts focus from earnings to ownership. It asks, if this company shut down today, what are its assets worth after paying off all liabilities? It's commonly used in real estate, banking, and industrial sectors, anywhere tangible assets dominate. You calculate it as total assets minus total liabilities equal to book value or net asset value. The downside, it often ignores intangibles like brand, innovation, or customer loyalty, and it assumes assets are worth their stated value, which may not always be true. For example, if Apple shut down today and sold off everything it owns, buildings, inventory, patents, what would be left for shareholders? That's asset-based valuation. Each valuation method has its time and place. Use relative valuation to compare companies quickly. Use absolute valuation when you want a deep company-specific analysis, and asset-based when assets drive the business or liquidation nears. All right, let's start our deep dive into valuation metrics with the one almost every investor knows, the P/E ratio or price to earnings. The P/E ratio is probably the most widely quoted valuation metric. It tells us how much investors are willing to pay for each dollar of a company's earnings. The formula is simple. PE is equal to price per share divided by the earnings per share, or EPS. So if a stock trades at $50 and its earnings per share are $5, the PE is 10. That means investors are paying $10 for every $1 of earnings. Now, what does that actually tell us? How do you interpret it? A high PE means investors expect strong future growth. It's priced for optimism. A low PE might mean a company is undervalued or it might be in trouble. But here's the trap. A low P doesn't automatically mean a good deal, and a high P doesn't automatically mean overvalued. There are always key risks and limitations to keep in mind. First, negative earnings make the PE meaningless. If a company loses money, you can't use this metric at all. Second, P varies wildly by sector and market cycle. A high growth tech company might have a PE of 40% and still be fairly valued. A mature utility might trade at 12. Third, accounting choices can distort earnings. One-time write-downs or aggressive depreciation can throw off the calculation. So how should we use it? Always compare PE to the company's own historical average, to industry peers, and to the broader market. For example, the S&P 500's long-term average PE is around 15 to 20. And more importantly, PE is just a starting point. It tells you how the market is pricing earnings, but it doesn't tell you anything about why. Next up is the PB ratio, or price to book. This metric shifts our attention from earnings to the value of what a company actually owns. The formula is straightforward. PB is equal to the price per share divided by the book value per share. Book value is just the company's assets minus liabilities, also known as shareholders' equity. So the PB ratio tells us how much investors are paying relative to the company's net asset value. A PB ratio under 1 means the stock is trading for less than its book value. In theory, you could buy the entire company for less than its net assets. A higher PB, like 3, 5, or even 10%, might be justified if the company has high returns on capital, valuable intangibles, or strong pricing power. But context is key. Is shines in asset-heavy industries like banks, insurance, real estate, and manufacturing? What are the limitations to watch for? First, intangibles are often ignored. A company might have massive brand equity, IP, or customer loyalty, none of which show up in book value. Second, outdated asset values. Book value reflects historical cost, not necessarily what those assets are worth today. Third, low P can be a trap. Just like a low PE, a low P could signal risk, not opportunity, especially if the company is earning poor returns or facing financial trouble. You'll want to use PB alongside ROE, or return on equity. This is a powerful combo. High ROE plus low PB displays strong return on equity at a discount, which means a potential value play. Low ROE plus low PB displays inefficient business, which could signal a value trap. PB is one of the few metrics rooted in what the company owns, not just what it earns. Use it when the balance sheet is core to the business model. Now let's talk about a metric that's incredibly popular among investment bankers, private equity analysts, and institutional investors, the EV, EBITDA ratio. This is a more advanced but incredibly insightful valuation tool because it compares the total value of a company to its core operating profitability. while removing the noise of financing decisions or non-cash accounting items. First, the formula. The EV/EBITDA is equal to enterprise value divided by EBITDA. Enterprise value EV includes the full cost to acquire the business, looked at as market cap plus debt minus cash. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's a rough proxy for operating cash flow, unlike PE, which only considers the equity side, EV. EBITDA looks at the entire company, both debt and equity holders. Best used in capital-intensive sectors and private equity analysis. What limitations should you watch for? Well, EBITDA excludes CapEx. Just because earnings look good doesn't mean the business isn't burning cash to stay afloat. EV accuracy depends on updated debt and cash data. Always check the balance sheet, or you could be over or underestimating true enterprise value. Lastly, it's not great for early stage or highly unprofitable companies. EBITDA must be positive, or this metric becomes distorted. A lower EV/EBITDA ratio generally signals a better value, assuming quality is intact. A higher EV/EBITDA may be justified by growth, margins, or brand strength, or it might signal overvaluation. EV/EBITDA is a powerful lens because it removes financing noise and focuses on core business performance. Use it to level the playing field when comparing companies. And don't forget to pair it with cash flow and capital expenditure data to round out your view. Next up, let's introduce a metric that helps us make sense of a high or low PE ratio, the PEG ratio, or price to earnings to growth. The PEG ratio takes the PE and adjusts it based on the company's expected earnings growth. It asks a really important follow-up question: how much am I paying for each unit of future growth? The formula is as follows. P is equal to the PE ratio divided by the annual EPS growth rate. So if a company has a PE of 20 and its earnings are expected to grow 20% per year, its PEG would be 1. A low PEG might indicate an opportunity, but only if the growth forecast is reliable. On the other hand, a high PEG could mean you're overpaying for optimism. But here's the caution: PEG relies on earnings growth projections, which are often based on analyst estimates. PEG works best when comparing high growth companies. It brings an important dimension to valuation: time. As stated earlier, PEG works best when comparing high growth companies, especially in sectors like tech or biotech. It can help justify a high PE if the company is growing earnings fast enough, but it's less useful in slow growth or cyclical industries where earnings swing wildly. Let's say Company A has a PE of 25, but earnings are growing at 30%. This gives us a PEG of 0.83. Company B has a PE of 15, but only 5% growth. This yields a PEG of 3. Even though Company A looks more expensive on a PE basis, it might actually be better valued relative to growth. Let's talk about intrinsic value, the core idea behind absolute valuation. At its heart, intrinsic value is the present value of all future cash the business is expected to generate. In other words, what is this company worth based on what it will earn, not what others are willing to pay today? And the most common way to calculate intrinsic value is through a discounted cash flow model, or DCF. The idea behind DCF is to take the company's expected future free cash flows, discount them back to today using a required rate of return, and then add in a terminal value, which represents the business's value beyond the forecast period. Key inputs include projected free cash flow, what the company is expected to generate in future years, discount rate, usually the company's WACC, or what investors demand in return for risk. terminal value, the estimated value of the company beyond the forecast period. This is often the largest part of the DCF. Unlike PE or EV/beta, which compare the company to others, DCF is independent. It says, let's forget the market. Based on fundamentals alone, what is this business worth to us? This is why DCF is a go-to tool in long-term investing, private equity, and mergers and acquisitions. But DCF also has risks. It's incredibly sensitive to assumptions, which means valuation can swing dramatically. It depends on realistic forecasts, and the terminal value can make up more than half the final number. DCF is a direct way to answer what is a company worth on its own. Let's bring this to life with a quick example. Imagine you're analyzing a business that's expected to generate $10 million in free cash flow next year, and let's say that cash flow is projected to grow at 5% annually. Now, if you're using a 10% discount rate, which might reflect your required return or the company's cost of capital, and you build a model projecting out 5 years of cash flow plus a terminal value at the end, you might estimate that the intrinsic value of the company is around $200 million. Okay, now let's say the market cap, the current price the market is putting on this company, is only $150 million. That's a 25% discount to your estimate of fair value. So in theory, this stock is undervalued. The market hasn't priced in its full future earnings power. But flip the scenario. Let's say the market cap is $250 million instead. Now the stock looks overvalued, at least based on your assumptions. That doesn't mean you're wrong, but it means you either need to believe the company will grow faster, that risk is lower than you thought, or that the market is simply ahead of itself. And that's the beauty of DCF. It's not just about the final number. It's about how you got there and whether the assumptions really hold up. Now that we've covered the core valuation tools, let's shift focus to how investors actually apply them in the real world through two primary investing styles, growth and value. These aren't just technical strategies. They reflect different philosophies about where to find opportunity and what worth really means. Growth investors focus on companies they believe will expand earnings or revenue rapidly in the future. These businesses often trade at higher valuations with elevated P/E ratios, PEG ratios, and sometimes no profits at all. The logic is you're paying a premium today for a company that will be significantly more valuable tomorrow. Think of names like Tesla, Shopify, or Nvidia. Businesses where investors are betting not on where the company is, but where it's going. Value investors, on the other hand, look for companies that appear underpriced based on fundamentals. They seek out low PE or low PEB stocks, strong cash flow, stable earnings, and a solid balance sheet. Often in less glamorous or mature industries, you'll find value investors picking through names like Johnson & Johnson, Verizon, or even legacy industrials. Their thesis? The market has overlooked something, and over time, price will catch up to value. Here's the key idea. Growth investors are buying potential, value investors are buying a discount, but these styles are not mutually exclusive. They're complementary. In fact, many seasoned investors use a blended approach. Warren Buffett is often labeled as a classic value investor, but his investment in Apple, a tech growth company, was based on strong fundamentals and cash flow consistency. That's value thinking applied to a growth stock. Value investors, on the other hand, look for companies that appear underpriced based on fundamentals. They seek out low PE or low PEB stocks, strong cash flow, stable earnings, and a solid balance sheet. Often in less glamorous or mature industries, you'll find value investors picking through names like Johnson & Johnson, Verizon, or even legacy industrials. Their thesis? The market has overlooked something, and over time, price will catch up to value. Here's the key idea. Growth investors are buying potential, value investors are buying a discount, but these styles are not mutually exclusive, they're complementary. In fact, many seasoned investors use a blended approach. Warren Buffett is often labeled as a classic value investor, but his investment in Apple, a tech growth company, was based on strong fundamentals and cash flow consistency. That's value thinking applied to a growth stock. Of course, both approaches have risks. Growth investing runs the risk of overpaying for hype. A company might look like the next big thing, but if expectations fall short, valuations can collapse quickly. Value investing isn't automatically safer either. Sometimes a stock is cheap because it deserves to be. Maybe it has weak leadership, low margins, or is stuck in a declining industry. That's the danger of a value trap. As you think about your own investing style, ask yourself this: are you more drawn to the excitement of future potential or the discipline of buying quality at a discount? Do you lean toward companies with momentum and vision, or those with balance sheet strength and historical performance? Understanding whether you tilt toward growth, value, or a mix of both will help you better interpret valuation metrics and clarify what kind of investment stories resonate with you. Now that we've talked about how valuation is used to spot opportunity, it's just as important to recognize when those same tools might be giving you a false signal. This slide is all about learning to spot valuation red flags, the warning signs that something might not be what it seems. One of the biggest traps new investors fall into is thinking that a stock with a low PE or a low PB is automatically a bargain. But price alone doesn't tell the full story. Sometimes a low valuation just reflects a company in decline or one that carries hidden risks. Red flag number one: declining or negative earnings. A P of 7 might mean the market is undervaluing a stock, or it might mean that earnings are about to fall off a cliff. For example, if a company has declining earnings year over year, the PE might look artificially low, but it's really just a sign that profitability is shrinking. That's not a discount, that's a deteriorating business. Red flag number 2: misleading PEG ratios. You also want to watch out for low PEG ratios that are based on unrealistic growth projections. If analysts are expecting 50% growth for the next 5 years, but the company has no track record of hitting targets, you may be dealing with optimism, not reality. The number looks good, but it's built on sand. Red flag number 3: poor capital efficiency. Then there are red flags on the balance sheet. If a company has a high PB ratio, but very low returns on equity, it means investors are paying a premium for a business that isn't doing much with its capital. That's inefficient and potentially dangerous in tougher market environments. Red flag number 4: EBITDA versus free cash flow. Sometimes EBITDA looks great, but the company is spending huge amounts of cash just to maintain operations. If a business has solid EBITDA but no free cash flow, you may be overvaluing it. Now, before you ever label a company as undervalued, a simple framework that can save you from chasing numbers that look attractive but don't hold up under scrutiny. Start with this question: is the company profitable? If the answer is no, that doesn't mean it's bad, but you need a strong reason to believe profitability is coming. Next, is it growing or shrinking? You might find a company with low P or low EV/EBITDA, but if revenue and earnings have been declining for 3 years, that low multiple is justified. Then ask, is it generating real free cash flow? That's the money that builds value for shareholders. Take a hard look at the balance sheet. Does the company have manageable debt? And finally, do insiders believe in the business? Are executives buying shares with their own money? Are they repurchasing cheap stock? Put all these together and you get a much clearer look into what determines value. Now that we've learned how to spot valuation opportunities and red flags, let's talk about how to actually find and analyze this data in the real world. Because having the right tools and knowing how to use them is what turns theory into action. The good news is that you don't need an expensive Bloomberg terminal or a CFA to start doing real analysis. There are several powerful free platforms you can use right now to evaluate stocks using the valuation metrics we've covered. The first is Yahoo Finance. This is a go-to for pulling up valuation metrics quickly. Just type in a stock ticker and click the Statistics tab to find PE, PEG, PB, profit margins, and more. Under Analysis, you'll see Future Growth Projections, essential for calculating PEG. And the Financials tab is where you can view the company's income statement, cash flow, and balance sheet all in one place. Next is finviz.com, a stock screener that's incredibly helpful for filtering companies based on valuation criteria. You can screen for stocks with a P under 15, a PEG under 1.5, or ROE above 10%. It's great for spotting outliers and comparing multiple companies side by side. Then we have TradingView, which blends technical and fundamental data. It lets you chart valuations over time, so you can actually see how a company's PE or FCF yield has changed across market cycles. That context is huge. If you want more qualitative depth, tools like Seeking Alpha offer investor commentary and earnings call transcripts, which are helpful when you want to understand the story behind the numbers. And for more serious long-term research, Morningstar is an excellent resource for digging into 5 and 10-year valuation trends, especially for blue chip companies. But here's the real point. It's not about memorizing where to find every data point. It's about developing the discipline to ask the right questions and knowing where to go when you need answers. When you pull up a company, don't stop at is the P low, go deeper. What's driving earnings? Is free cash flow consistent? Is the valuation rising while fundamentals are flat? What do peers in the same sector look like? And always cross-reference across multiple platforms. Sometimes numbers vary slightly depending on how they're calculated or when they're updated. Confirming your inputs builds confidence in your conclusions. So whether you're scanning dozens of companies for opportunity or doing a deep dive on just one, these tools help turn valuation theory into real, actionable insight. Coming up next, we're going to tie all of this together with a real-world case study. In the next slide, we'll compare 3 iconic companies, Apple, Tesla, and Johnson & Johnson. Let's now take everything we've learned, the metrics, the red flags, the tools, and apply it to a real-world comparison. In this slide, we're looking at 3 iconic companies from very different industries, Apple, Tesla, and Johnson & Johnson. Each of these businesses is successful in its own way, but when you look at their valuation profiles side by side, it becomes clear just how different the market's expectations are and how valuation reflects those expectations. Let's start with Apple. It's a massive, profitable tech company with consistent earnings, strong brand loyalty, and tons of free cash flow. Its P is usually in the mid -20 seconds, and that might seem high for a mature company. But it's backed by margin stability and buybacks. Its PEG ratio is above 2%. Tells us the market is pricing in slower growth ahead. But because Apple is seen as a safe tech name, many investors are comfortable paying a premium for quality. Now contrast that with Tesla. This is a classic high-growth story, a company with a sky-high PE, an elevated EV/EBITDA, and relatively modest free cash flow compared to its market cap. But Tesla's valuation isn't just about earnings, it's about the narrative. Investors are buying into the long-term potential of autonomy, energy, AI, and more. And while its PEG ratio might look more reasonable because of rapid projected growth, the real question is whether Tesla can live up to those expectations consistently. And then we have Johnson & Johnson, a mature, dividend-paying healthcare giant. Its PE is much lower, often in the mid to high teens, and it throws off strong, reliable free cash flow. It doesn't grow quickly, but it doesn't need to. It's priced for stability, not explosive upside. Investors buy J&J for balance sheet strength, resilience, and income, not for a moonshot. So, what do these profiles tell us? They tell us that valuation is not one size fits all. Tesla trades at a premium because of its growth story. J&J trades at a discount because it's predictable. Apple sits somewhere in the middle, premium price, but with fundamentals to back it up. And here's the deeper lesson. The numbers don't tell you what to buy. They help you understand what you're paying for. Is the stock priced for perfection, or is it priced for pessimism? Does the valuation make sense given the company's story, sector, and fundamentals? And most importantly, do you agree with what the market is pricing in? Valuation isn't about finding the cheapest stock. It's about finding a mismatch between price and business reality. And when you can identify that mismatch, you create an edge. Up next, we'll round out our toolkit with a few bonus metrics. So far, we've covered the foundational tools of valuation: PE, PB, PID, EV/EBITDA, and DCF, the metrics that show up in every textbook, earnings report, and analyst pitch. But now it's time to go a level deeper, because here's the truth. Real-world investing is rarely black and white. The best investors, the ones who find quality early or avoid hidden risks, are the ones who go beyond the surface. They don't stop at low PE is good or high EBITDA is bad. They ask better questions, and they use better tools to answer them. These bonus metrics aren't meant to overwhelm you. They're meant to refine your perspective. Each one opens up a different angle on value. Some focus on cash, some on sales, some on capital efficiency, and some on investor income. And while they don't all apply to every company, knowing when to use them and what they're telling you will give you a real edge. Let's start with price to sales, or PS. This is one of the simplest valuation tools, and also one of the most commonly used when a company doesn't yet have earnings. It tells you how much investors are paying for every dollar of revenue. If a company has a market cap of $10 billion and $2 billion in annual revenue, its P's is 5. That means the market is valuing each dollar of sales at $5. S is most useful for early stage companies, like high growth tech firms, where earnings are negative but revenue is growing quickly. It's also a good way to evaluate companies with volatile profits but consistent top-line sales. But here's the caution. Revenue alone doesn't mean much without profitability. A high PS can be justified if margins are strong and the company is scaling, but it can also signal irrational optimism if cash burn is high or revenue is slowing. That brings us to a more refined tool, price to cash flow, or PCF. While earnings can be distorted by non-cash accounting, like depreciation, amortization, or one-time charges, operating cash flow is harder to fake. This ratio tells you how much you're paying for each dollar of real cash coming into the business. It's especially useful for capital-intensive industries like energy or telecom, where GAAP earnings don't reflect economic reality. If you want to take it one step further, You can zoom in on free cash flow yield. This flips the equation and looks at how much free cash flow the company generates relative to its market cap. In other words, how much cash you're getting back for every dollar you invest. A company with a 6% FCF yield is producing 6 cents of free cash flow for every $1 of valuation. That's like earning a 6% yield. But instead of dividends, you're measuring raw value creation. Why does this matter? Because free cash flow is what's left over after a business pays for everything it needs to operate and grow. And it's the money that can actually be returned to shareholders, used for buybacks, dividends, or reinvested at high returns. So when PE is noisy or unavailable, and when earnings don't tell the full story, these three tools, P's, PCF, and FCF yield, give you a clearer lens into what the company is actually producing. Use them to cut through the accounting fog and focus on what matters most: cash. As we continue expanding your valuation toolkit, this slide brings together 3 advanced metrics that help you evaluate very different kinds of companies, whether they're fast growing, income generating, or capital efficient. We're talking about EV to revenue, dividend yield and payout ratio, and return on invested capital, or ROIC. Let's start with EV to revenue, or enterprise value to revenue. This is one of the most useful ratios when you're analyzing early stage or unprofitable companies, especially in sectors like tech, biotech, or clean energy, since these companies might not have earnings and sometimes not even EBITDA. You can't use PE or EV/EBITDA. So instead, you look at their revenue as a baseline for comparison. EV revenue asks, how much is the entire company, including its debt, valued relative to the total sales it's generating? Next, let's shift to a more conservative lens: dividend yield and payout ratio. Tools used to evaluate companies that return capital to shareholders consistently. Dividend yield shows how much income you're receiving annually as a percentage of the stock price. If a stock pays $4 per year in dividends and trades at $100, that's a 4% yield. This is particularly important in sectors like utilities, real estate, consumer staples, and energy, where income matters more than aggressive growth. But yield alone isn't enough. You also need to look at the payout ratio, which tells you what percentage of a company's earnings are being paid out as dividends. A sustainable range is typically 30 to 60%. Anything higher, especially over 100%, could mean the company is overextending, dipping into reserves, or taking on debt to maintain its dividend. That's not sustainable. Finally, we have return on invested capital, or ROIC. This metric tells you how effectively a company uses its capital, both debt and equity, to generate profit. In simple terms, it answers, for every dollar the company invests, how much value does it actually create? A company with a high ROIC is signaling that it doesn't just grow, it grows efficiently. It knows how to turn investments into real returns. This is the kind of metric that separates great companies from average ones, especially over long time horizons. And here's the key insight: when ROIC is consistently higher than the company's cost of capital, that company is creating value. But if ROIC falls below the cost of capital, it might be growing, but it's doing so in a way that actually destroys shareholder value. So to bring it all together, use EV revenue when companies aren't profitable, but you still want to benchmark valuation. Use dividend yield and payout ratio when income and capital return are key drivers. Then use ROIC when you want to measure quality. Now it's time to take everything you've learned this week, from traditional ratios to advanced valuation tools, and put it into practice. Your assignment is a valuation deep dive. where you'll choose a publicly traded company and build your own valuation profile from the ground up. You'll start by selecting 3 companies, ideally a name you're curious about or already have some familiarity with. Then you'll use at least 5 valuation metrics to analyze it. These can include anything we've covered: PE, PB, EBITDA, PEG, FCF yield, ROIC, you name it. Choose the ones that make the most sense for the company's business model and growth stage. But don't stop at raw numbers. Your goal is to interpret them. What do these metrics say about how the company is priced today? Are there any red flags? Is it overvalued, undervalued, or fairly valued based on the fundamentals? To push your thinking further, you'll also compare your chosen stock to at least 2 peers in the same industry. This will help you understand where it stands relative to the competition and whether the valuation is justified or off base. This assignment isn't about getting the right answer. It's about building your ability to think like an analyst, to ask sharp questions, interpret data, and develop conviction in your own ideas. Take your time, use the tools we've covered, and remember, this is how you turn information into insight. As part of this week's assignment, I'm also asking you to engage with 2 foundational readings that will deepen your understanding of valuation, not just in terms of tools, but mindset and process. The first is The Little Book of Valuation by Aswath Damodaran. Damodaran is one of the most respected voices in modern finance, and this book is designed specifically for investors who want to bridge the gap between textbook valuation and real-world application. I recommend focusing on chapters 1 through 3. These cover what valuation actually is, how it differs from pricing, and how to tailor your approach depending on the type of business you're analyzing. Pay special attention to his breakdown of intrinsic versus relative valuation. It'll reinforce much of what we've covered in this session. The second book is The Most Important Thing by Howard Marks. While Damodaran gives you the mechanics, Marks gives you the mindset, the judgment and temperament that surround good investing. The chapters on understanding risk and value are especially relevant. He pushes you to think in terms of cycles, expectations, and second-level thinking, all of which are critical when interpreting valuation signals in a noisy market. As you read, take note of 1 or 2 insights that really shift your perspective. What challenged your thinking? What clicked for you? You'll have a chance to reflect on these in the optional bonus question at the end of the assignment. These aren't just academic readings. They're mindset anchors. They'll give you the vocabulary, clarity, and conviction to go beyond plugging numbers into a model, and instead to really understand why something is or isn't worth what the market says. We've spent this entire session breaking down valuation tools, learning how to measure price, compare peers, model cash flows, and flag red flags. But now I want to step away from the spreadsheets for a moment and ask a deeper question. What is value really? That's where we cross into philosophy, and that's the heart of this Beyond the Charts segment. Let's take a cue from Plato. In the Republic, he describes the allegory of the cave, where people mistake shadows for reality because they've never seen the light. In the same way, investors often mistake price for value. They see what the market believes, not what the business is actually worth. Valuation is about turning toward the light. It's about seeing clearly when others can't, and thinking independently when the crowd moves blindly. Robert Pirsig, in Zen and the Art of Motorcycle Maintenance, explores the elusive concept of quality, something you can't always define, but you know when you see it. Valuation is the same. You can't reduce great businesses to a single number. Sometimes value shows up in consistency, leadership, culture, or resilience, none of which are captured in a PE ratio. Then there's Laozi. in the Tao Te Ching, who reminds us that wisdom often lies in patience and restraint. Great investors understand that value is revealed over time, not in the tick-by-tick movements of the market. Valuation isn't about chasing momentum. It's about positioning wisely and letting the truth unfold. So here's your mindset challenge for this week. When you say a company is undervalued, what do you really mean? Are you relying on numbers, narratives, hope? Are you seeing the business as it is or as you want it to be? You've now built a complete valuation toolkit from PE and EV/EBITDA to PE, DCF, ROIC, and more. You've learned how to assess value across industries, spot red flags, and interpret price in the context of both fundamentals and narrative. But don't forget, valuation is never just about numbers. It's about perspective. It's about asking, what is this business really worth? And why might the market have it wrong? That mindset is what separates noise from opportunity and math from meaning. Next week, we take everything you've learned and level it up. Research a company like a real analyst. Evaluate the moat, management, growth story, and risks, and pull it all together into a cohesive, high conviction investment thesis. Whether you're pitching an idea, making a trade, or building a portfolio, this is the session that teaches you how to communicate and defend your ideas with clarity and confidence.